For thousands of years, money has always been about one thing: trust. Long before banks existed, long before vaults, credit cards, and digital ledgers, trust lived inside stone walls. In the ancient world, the first financial institutions were not corporations or governments, they were temples. In ancient Babylon, priests became the earliest bankers in recorded history. People brought their grain, livestock, and valuables to temples, not only because of religious belief, but because temples were the most secure structures in the city. Thick walls, constant guards, and the fear of divine punishment made theft almost unthinkable. Over time, people learned that the safest place for their wealth was not their homes, but the temple. When someone deposited their grain or goods, a priest would record the transaction on a clay tablet. It might say that a certain individual had 10 sacks of wheat stored within the temple. That clay tablet was more than a record. It represented ownership. It was transferable. It could be trusted. In effect, it was the first bank receipt in human history. That simple idea changed everything. Wealth no longer needed to be physically moved to be used. Trust could be recorded. Authority could guarantee value. And power slowly began to concentrate around those who controlled the system. As centuries passed, empires rose and collapsed, but the basic idea remained the same. Whoever controlled the flow of money controlled society. By the time Europe entered the Renaissance, banking had evolved into something far more sophisticated and far more dangerous. In Italy, one family perfected the system. The Medici did not just store money, they created networks. They connected cities, kingdoms, and entire economies. They loaned money to kings and popes. They financed wars, political alliances, and imperial ambitions. Behind the scenes, they decided who had power and who did not. At that moment in history, banks stopped being passive vaults. They became active forces that shaped the world. The ability to create credit meant the ability to create reality. Armies marched because banks funded them. Thrones were secured because banks chose sides. Entire nations rose or fell based on access to capital. For centuries after that, the role of banks barely changed. They stood between people and their money. They stood between buyers and sellers. They became the mandatory middleman of every economic interaction. If you wanted to save, borrow, invest, or transfer value, you needed a bank. Banks became trusted institutions, protected by governments and backed by law. They were seen as pillars of stability, the guardians of personal wealth and national economies. For most people, the idea that banks could ever be challenged was unthinkable. Then came 2008. The global financial system collapsed under its own weight. Banks that were supposed to manage risk had created massive hidden dangers. Complex financial products, reckless lending, and unchecked leverage pushed the system to the brink. When it failed, ordinary people paid the price. Jobs were lost, homes were foreclosed, savings disappeared, and yet the institutions responsible were rescued. In the middle of that chaos, something unusual happened. While governments were bailing out banks, a document quietly appeared on the internet. It was only 9 pages long. It had no corporate backing, no institutional support, no known author. The name attached to it was Satoshi Nakamoto. The document described a new kind of money, a system that did not rely on banks, a system with no central authority, a system where trust was enforced by mathematics instead of institutions. Anyone, anywhere in the world, could send value directly to anyone else without asking permission. No bank approval, no intermediary, no delays. That idea became Bitcoin. At first, almost no one paid attention. Bitcoin was dismissed as a curiosity, a niche experiment, a toy for cryptographers. But slowly, it grew. And with it grew an entire ecosystem of digital assets, blockchains, and decentralized networks. Most people focused on Bitcoin's price, its volatility, its rise and crashes. But behind the noise, something far more important was developing quietly: stablecoins. Unlike Bitcoin, stablecoins were designed not to fluctuate wildly. They were designed to behave like money. Their value was pegged to traditional currencies, most commonly the US dollar. 1 unit of a stablecoin was intended to equal $1 consistently. The reason was simple. Bitcoin was powerful, but it was unstable. It could not easily function as everyday money. Stablecoins were created to solve that problem. The first major stablecoin appeared around 2015. Its goal was to create a bridge between the traditional financial system and the new world of crypto. Instead of converting dollars directly into volatile digital assets, users could move into stablecoins first, preserving value while remaining inside the blockchain ecosystem. Over time, many stablecoins emerged. While they shared the same goal, they differed in structure. Some were backed by real dollars and government bonds. Some were backed by other cryptocurrencies at higher collateral ratios. Others relied purely on algorithms and market incentives. History quickly exposed which models were fragile. Algorithmic stablecoins collapsed dramatically when market confidence disappeared. Entire ecosystems vanished almost overnight. Trillions in paper value were wiped out, but fully backed stablecoins survived. These stablecoins claimed to hold real reserves for every unit issued: dollars, treasury bonds, highly liquid assets. And for years, their biggest weakness was trust. Governments had not officially recognized them. Regulators had not fully verified them. Skepticism remained. That changed in 2025. In July of that year, the United States passed landmark legislation that formally recognized fully backed stablecoins as legitimate financial instruments within the traditional financial system. For the first time, stablecoins were no longer operating in a gray zone. They became legal. This single decision reshaped the global financial landscape almost instantly. Stablecoins were no longer just tools for traders and crypto enthusiasts. They became usable for real economic activity. International transfers that once took days could now happen in minutes. Businesses could settle invoices instantly across borders. Payments could move 24 hours a day without regard for weekends or holidays. Banks themselves were allowed to offer stablecoin accounts alongside traditional accounts. Stablecoins could be connected to debit cards and used in everyday life. The walls separating crypto from the banking system began to dissolve. Stablecoins did not attack banks from the outside. They entered through regulation. I am Tom from the Orange Dots channel, and what we are witnessing is not a trend. It is a structural shift, and the real threat to banks is not technology. It is incentives. Banks operate on a simple model. They take deposits from customers and pay very little interest. Then they lend that money out at higher rates. The difference is profit. Without deposits, banks cannot function. Deposits are the fuel of the system. Stablecoin platforms disrupted this balance. While traditional savings accounts in many countries pay close to zero interest, stablecoin platforms began offering yields exceeding 4%, in some cases even higher. The difference is not small, it is enormous. Rational people follow incentives. When individuals realize they can earn significantly more by holding stablecoins than by leaving money in a bank account, they move their funds. This is not speculation. It is already happening. In early 2025, the U.S. Treasury issued a warning. Trillions of dollars in bank deposits were at risk of migrating to stablecoin platforms. Not a small fraction, a significant portion of the entire system. Banks depend on deposits to issue loans. Loans fund businesses. Businesses create jobs. When deposits leave, credit contracts, growth slows. Entire economies feel the impact. This is where the danger lies. Not in crypto markets collapsing, but in capital quietly draining from the traditional system. Beyond interest rates, stablecoins attack banks at their most profitable points: international transfers and lending. Anyone who has ever sent money across borders through a bank understands the frustration. High fees, slow processing, unclear exchange rates, multiple intermediaries taking a cut. A transfer of $100 might arrive as 94 with no clear explanation. Banks profit heavily from this friction. Stablecoins remove it. A stablecoin transfer can be completed in minutes. Fees are minimal. The transaction is transparent. The system operates continuously. No holidays, no banking hours, no manual processing. For millions of people in developing countries, this difference is life-changing. Remittances become cheaper. Access to global markets becomes easier. Financial inclusion expands. Lending is also changing. Decentralized finance platforms allow users to borrow and lend without banks. Smart contracts enforce rules automatically. Collateral is deposited. Loans are issued instantly. Repayment returns the collateral. No paperwork. No interviews. No credit scores. Code replaces bureaucracy. Banks cannot compete on speed or efficiency in this environment. Their strength has always been trust and regulation. But now stablecoins are regulated too. This raises an uncomfortable question. If banks no longer dominate deposits, transfers, or lending, what role do they play? The answer is not extinction. It is transformation. History offers many examples. Video rental stores did not disappear because people stopped watching movies. They disappeared because they failed to adapt. Taxi companies did not vanish because people stopped traveling. They vanished because they resisted change. Banks face the same choice. Institutions that integrate blockchain technology, offer stablecoin services, modernize infrastructure, and reduce friction will survive. They may even thrive. Those that deny the shift, dismiss it as temporary, or rely on outdated systems will slowly lose relevance. In developing regions, stablecoins may leapfrog traditional banking entirely. Billions of people remain unbanked, not because they choose to be, but because banks are inaccessible. Stablecoins only require a smartphone and internet access. This could bring billions into the global financial system for the first time, not as customers of banks, but as participants in a decentralized economy. In developed economies, competition will intensify. Banks will be forced to raise interest rates, improve services, and adopt new technologies. Employment inside banks will change. Routine roles will decline. Technical and risk-focused roles will expand. Financial education will also change. Understanding blockchain, smart contracts, and digital assets will no longer be optional for financial professionals. It will be essential. We are living through a historical transition. Not the end of banks, but the end of banking as it has existed for centuries. The real danger is not disruption. It is complacency. Money has never been static. From clay tablets to paper notes to digital ledgers, it has always evolved. Each transformation redistributed power. Each shift created winners and losers. Today is no different. The silent war between banks and stablecoin platforms is still in its early stages, but its outcome will shape the future of finance, governance, and economic freedom. The only question left is how fast this transformation will reach different parts of the world. Will regions adapt quickly and shape their own systems, or will they react slowly and be forced to import solutions from elsewhere? That is the question I leave you with, because history shows us one thing clearly. Those who understand change early gain power. Those who ignore it are remembered only after they are gone. If you made it this far, you're already ahead of most people, and the future is arriving faster than anyone expected.